Hi, everyone. Thanks so much for joining. We have a really packed week, of course. It is the Fed week. So we have a Federal Reserve meeting on Wednesday, and the markets are already reacting to this, or maybe they have reacted already. But we've certainly got a cautious run up to that. Let's dive straight into the charts and take a look at what I'm talking about now. As usual, you'll notice this, my favorite world equity market chart. So if you just follow my pointer here, European markets open on Monday, the 8th of December. So slight decline today, very, very mild risk off, I would say, a drop of 0.03% for the FTSE 100 and about the same drop for the Euro Stoxx index. Slightly bigger drop for the CAC, down 0.2%, but nothing massive going on. And one thing I would point out actually is if we look just to where my pointer is now on the right hand side and up slightly at the top level there, we're looking at the 5-day gains for the S&P 500 and the Nasdaq. They did manage to eke out a gain last week, and let me just pull up that S&P 500 chart, because we're seeing it's been quite slow going, but we are inching towards that record high in the S&P 500. So it comes in at 6,920. That's the high from the 29th of October. And we're currently trading 6,870. That's where we closed on Friday. So all focus now is on whether US equities can reach these record highs. As I mentioned, it's very, very slow going. You can just look at this chart on the right-hand side here. You can see that the candles are absolutely tiny. No more of these big declines and then big reversals. The last couple of weeks have seen really, really small moves. So we are taking absolute baby steps towards those record highs. But that's really the focus. And I think the reason why, when we have this kind of sideways trading pattern, the market doesn't want to sell off equities. It doesn't necessarily want to breach record highs either, because we're waiting for this big event, which is the Federal Reserve meeting. Now, the Federal Reserve is expected to cut interest rates this week, on Wednesday, Wednesday evening our time. They're expected to cut by 25 basis points. However, what's really unclear is what they do next. Now, we are going to get their latest economic updates, and we'll also get the dot plot. Now, I want to show you their last dot plot, because I think this is really important. And we will obviously be covering it live, and we will also be we'll also be posting coverage, and we'll be updating the dot plot, the economic projections, and obviously all the live market action as well on Wednesday evening. But between now and then, for 2025, everyone had kind of expected rates to end the year above 3.5%, which is roughly where we are now, slightly more hawkish than that. But then it was looking at where rates will go to next year. And as you can see, for 2026, there was a really wide dispersion of where rates would go to, somewhere below 3.5%. But to be honest, there were still a lot of people looking for rates to remain pretty much on hold. So yes, we're seeing a move downward. So we are seeing rates lowered next year, but not by any there's no clear signal here. And we think the same thing could happen after the latest dot plot. Now, this is the dot plot from the 17th of September. We then get the next one in December. You don't get them every meeting. They just come every kind of 3 months or so. So, this doesn't really tell us anything. This doesn't give us too much direction, particularly for longer out the curve, that actually rates will, the terminal rate could be above 3%. Some people had expected to be about 2.5%. And also rates not really expected to move very much at all for the next 3 years until 2028. So this is a very, very interesting dynamic, and one that we'll be looking at to see if it changes at all. So while there is kind of a movement down in rates for 2026, just how much? Also, we've got sticky inflation, and there are signs in the stock market that we are seeing cyclicals rally. And usually when that happens, it's when we're getting a reacceleration of growth in the US. Could they even lift this dot plot? Will some people see kind of maybe the next move in rates as being on the upside? Because we know that there are some hawks on the Federal Reserve. Certainly up until May, there will be anyway, when Jerome Powell will hand over the reins. But I think that we've got a very unclear outcome. Certainly in the first 6 months, we'll still have Jerome Powell there. Now, he could influence policy. Obviously, after May, we're going to get Trump's pick. That could be Kevin Hassett. It's all expected to be Kevin Hassett. He is likely to have a more dovish stance. He's likely to do what Trump wants. However, it is one man, one woman, one vote at the Federal Reserve. So that he's not necessarily going to get his way. So this dot plot is going to be so interesting. I look at the dot plot. It may look really, really complicated. Don't worry, it's not. This is suggesting in September, they suggest that the rates would fall next year, and we'll be looking to see whether or not this stays up or down. And also where kind of the median range is for US interest rates next year. But for now, this is everybody is going to be watching this, and the market reaction will really be based on it. Now, one chart that I also want to show you as well is, as I mentioned, we have some really good, some pretty positive signs actually for the best performing stocks in the US and what's driving markets. And if we look at the Russell 2000, so that is the mid-cap stocks in the US, they made a record high last week. So they had moved higher. They came off a little bit on Friday, but we really did see some strength in that mid-cap rally, in that mid-cap stock index last week. We also saw strength for banks with the KBW banking index that rose over 3%, alongside some pretty good movements as well in tech. But I think what's interesting is that we're broadening out beyond tech. It's not just all about the tech rally and all about AI. As we move to the end of the year, yes, the rally is a bit slow going, but it has moved beyond tech. So we're seeing some big gains everywhere. Obviously, the big news at the end of last week was Netflix acquiring or trying to acquire Warner Brothers. Now, over the weekend, there was some news from Trump who said this is a very big deal. There could be monopoly risks and that it would be looked at very closely. So there's going to be a lot of scrutiny. Polymarket, which is a kind of betting site on events, that's now predicting a 20% chance of that deal going through by the end of 2026. On Friday, it was a 60% chance. So with all this extra regulatory scrutiny, it could take a very long time for that deal to actually be passed. That is why we're seeing Netflix's stock price, which fell last week, because remember, it's the acquirer, it's spending all the money on Warner Brothers. So typically the acquirer's share price falls, and we did see Warner Brothers' share price go up. But today, Netflix is actually up by about 1.5% in the pre-market on Monday, the 8th of December. And that's kind of maybe markets just thinking this deal's going to take a bit longer. So they're not going to have to commit anything quite yet. I'd also bring your attention to the weakest performer last week in the S&P 500. Now, that was Paramount. It was down 16.5%. Paramount, of course, is Netflix's biggest rival. So even though there are big hurdles to this deal, it is still it could still be a fantastic tie-up. And I think the market and the financial markets and investors are saying this is going to be really hard for Netflix's competitors to compete in that space, because they're going to have the best back catalogue. They're going to have fantastic content and content creators and filmmakers all coming over from Warner Brothers, which could just make this absolute behemoth of film and TV going forward. How can Paramount, for example, benefit from that, from the economies of scale, but also from the money that they can start throwing at content? So that's why Paramount was the weakest performer in the S&P 500 last week. I just want to show you some commodities. We've seen, yes, gold is really hovering around that 4,200 level. No one is willing to let gold give up the ghost there. It is trading, it's really keeping above that 4,200 level. Yes, we're back about $200 away from the record high that we saw on the 20th of October, but we still remain, above all the key moving averages, still in an uptrend. But again, it's really, really small pieces. I think if we get a hawkish Fed, that's when we could see the gold price start to fall, with 4,084, the 50-day moving average, being the key level to watch there. Just to show that there's a little bit more risk off, a little bit more caution in markets today. This is world bond markets. As you can see, a sea of red in Europe. So bond prices are falling, bond yields are rising. That's why it's all in the red. And we're seeing about similar-ish gains across Europe and the UK. So 4 basis point gain for France, 4 basis point gain for the United Kingdom, even 4.4 for Germany. So just as stocks sell off, we're seeing bonds sell off as well. But one thing I will leave you on, which is a very interesting development, I want to show you this chart. We have spoken about earlier in November about how Bitcoin was basically dominating market action, and how Bitcoin, when it fell, had that precipitous fall from October. It fell really sharply in November, and then that dragged stocks lower in November. So it was almost as if Bitcoin was really driving and determining where other risky assets went. Now, there was no rhyme or reason for that. It was just seen as like this pure risk asset. And so when Bitcoin fell, it suggested that all sentiment had drained out of the market. Now, if we want to see a Santa rally, that has to break. Now, the white line in this chart is the MSCI World Equity Index, and the orange line is obviously Bitcoin. As you can see, Bitcoin has fallen. Bitcoin hasn't really been able to retrace many gains, and yet we've got the MSCI World Index close to record highs and really moving forward, trying to get that Santa rally. A lot of people really expecting that, but it seems like it's broken that link with Bitcoin. So Bitcoin is not determining where stocks go now, which is good news overall for risk sentiment. So that's it from us. Thanks so much for joining, everyone.